Okay, let's unpack this. What a week in digital assets. It really felt like this fundamental conflict playing out, didn't it?
Absolutely. One of the sharpest clashes we've seen in a while, I think.
Yeah, you had this fast money, the macro trading reacting instantly, leading to this big institutional risk-off event.
Right. And crashing right into that was what you call the slow money, this
Yeah.
like underlying build out of infrastructure and real world use cases that just keeps accelerating.
It was quite the collision.
A textbook collision, really. We saw traditional finance rules, Fed decisions impacting digital asset prices almost immediately through these new institutional channels. It forces panic.
Mm-hmm.
But like you said, beneath that short-term noise, the long-term foundation, it seems to be getting stronger, arguably faster than ever.
And the headline was definitely dramatic. Bitcoin's 7-year Uptober winning streak officially ended, a 3.6% loss for the month.
Broke the streak.
So our mission today really is to look past that volatility. We need to figure out which force, this macro shock or the structural growth, is actually setting the direction here.
Exactly, because this wasn't just random market chop. This was integration in action. We really need to focus on those big adoption trends that are picking up speed, even while some people are, panic selling.
Okay, so section 1, the macro shock and that price fallout. To really get the scale of the collapse, we have to remember where we were just before it happened.
Right. There was some serious bullish momentum building earlier in the week.
Yeah, the price was pushing towards $115,000. We'd reclaimed that key short-term holder cost basis around $113,000. Things were looking pretty good.
Yeah, optimistic even. But that changed fast. The catalyst, as expected, was the Fed's rate decision.
Everyone saw the cut coming, right? 25 basis points.
Pretty much baked in. Yeah, 98% certainty. The market got the cut it expected. But the surprise, the real sting in the tail, was Chair Powell's forward guidance.
That hawkish cut.
Exactly. He basically said, don't count on another cut next meeting. His words were, not a foregone conclusion, far from it.
And that just poured cold water on everything. The market heard. Less easy money coming.
Precisely. And that triggered a synchronized sell-off across, pretty much all risk assets. Bitcoin broke key support levels.
Dropped hard. Established a low near $109,000.
That's right. And that move triggered a massive deleveraging event, over $700 million in liquidations across the board. A lot of leveraged traders got wiped out.
Ouch. So technically, what did that do to the charts?
Well, it fundamentally shifted the structure. That crucial support zone, roughly $112,000 to $113,500, that's now overhead resistance. It flipped.
Okay.
So traders are now really focused on defending $109,000. If that level breaks, the next major structural support seems to be down near $106,400.
Which is near the miner cost basis, right?
Coincidentally, yes. It lines up pretty closely with the estimated average cost of production for miners. So a key level to watch.
And what about the derivatives market? Is it showing more fear, or are traders betting on a recovery?
That's the key question, isn't it? The implied volatility term structure, basically how much volatility traders expect, it moved into backwardation for the near-term options, meaning short-term protection, short-term hedges, got unusually expensive. Traders are pricing in higher immediate risk compared to risk further out. They're bracing for, choppy, tense price action in the immediate future. Now, section 2. How did institutions react? This macro shock translated directly into their behavior, especially in the spot ETF market.
We saw outflows, right? Big ones.
Yes, significant outflows. U.S. spot Bitcoin ETFs had 3 consecutive days of net outflows. The total hit roughly $1.15 billion.
Wow. $1.15 billion?
And the single biggest day was that $488.4 million outflow. Real pressure.
Were the big players involved, like BlackRock, Fidelity?
Oh, yeah. On that heavy selling day, Fidelity's FBTC led the withdrawals with about $164 million. ARKB saw a $143 million leave, and BlackRock's IBEAT recorded an $88 million outflow.
So this really shows, doesn't it, that this institutional money coming through the ETFs reacts exactly like traditional capital to macro risks. Fed sounds hawkish, Wall Street de-risks, and boom, it hits their crypto allocation instantly.
It absolutely confirms how integrated this asset class is becoming. Now, here's where it gets interesting, the nuance. It wasn't a total exit from crypto.
Okay.
It looked more like a sophisticated rotation. While Bitcoin and Ethereum ETFs saw those large outflows, spot Solana ETFs actually recorded net inflows. About $44.5 million came in.
Huh. So not just selling crypto, but shifting within crypto. What does that tell you?
It signals market maturity, I think. They aren't just panic selling the whole sector. They're making tactical decisions, maybe moving capital towards ecosystem-specific catalysts in Solana, perhaps seeing relative value there after Bitcoin's run. The capital is getting smarter, more selective.
That's fascinating, a capital rotation strategy in action.
Exactly.
But despite all this immediate pain and de-risking, we still have this historical pattern hanging over us, November.
Ah, yes, the seasonal narrative. Historically, November is Bitcoin's strongest month, statistically speaking. The average gain is something like over 40%.
Which sounds great, but then you have the skeptics,
who rightly point to Novembers like 2018 when the market crashed hard. So, seasonality is interesting, but it's definitely not a guarantee. Relying on it alone is risky.
All right, let's shift gears then. Section 3, long-term foundations and real-world application. While the short-term charts look, frankly, pretty scary, what about that slow money, the stuff happening underneath?
Right, the structural build-out. And it continued this week, despite the volatility. For instance, corporate accumulation didn't stop. Strategy Inc. bought another $43.4 million worth of Bitcoin.
And wasn't there another company, Prenetics?
Yes, exactly. Prenetics Global, they're a NASDAQ-listed health tech company. They raised $48 million specifically to add more Bitcoin to their corporate treasury. So that slow, steady conviction buy is still happening.
And it's happening from small companies right up to, well, global finance giants, right? Let's talk about those financial integration milestones. This is the real plumbing changing.
It really is. A huge step happened in the interbank market. DBS Bank in Singapore and Goldman Sachs, they executed the first interbank OTC options trade involving Bitcoin and Ether.
Okay, what does that actually mean for the market?
It's the beginning of a formal institutional derivatives market between major banks. It gives them TradFi tools to manage risk for crypto exposure. It's a massive legitimizing step for digital assets within the traditional banking system.
And speaking of infrastructure, the whole RWA tokenization space got a big boost too. Securitize going public?
Yeah, that's a major development. Securitize, the platform that helps firms like BlackRock actually bring real-world assets onto the blockchain. They announced plans to go public via a SPAC merger.
At a pretty hefty valuation, right?
$1.25 billion valuation. That's a huge public market benchmark for the whole RWA infrastructure thesis. Puts a real number on the value of that technology.
And other big banks are leaning in too.
Standard Chartered certainly is. They reiterated their expectation for massive growth in RWA tokenization and specifically highlighted Ethereum as a key network for it. That's significant backing from a major global bank.
Okay, and you can't talk about integration without talking about stablecoins, especially Tether.
Oh, definitely not. Tether's holdings of U.S. Treasuries hit $135 billion.
$135 billion. Just put that in perspective for us.
Well, it makes Tether the 17th largest global holder of U.S. sovereign debt. They hold more U.S. debt than entire countries like South Korea.
That is staggering.
It's profound. Tether isn't just a crypto payments tool anymore. It's a major player in global finance and, frankly, geopolitics, plugged right into the U.S. debt market.
And that financial weight is translating into actual payment utility, too.
For sure. Visa's CEO reported that their monthly stablecoin settlement volume, just across the networks they support, surpassed a $2.5 billion annualized run rate.
$2.5 billion a year moving via stablecoins on Visa-supported rails.
Yep. And Western Union isn't sitting idle either. They announced plans to issue their own stablecoin, USDPT, on the Solana network by 2026. More competition, more utility.
Even restaurants are getting involved now. I saw something about Steak and Shake.
Yeah, it's a great little anecdote, but it shows the breadth of adoption. Steak and Shake established a strategic Bitcoin reserve. They're actually holding the Bitcoin they receive as payment as a treasury asset.
Why? What's the benefit for them?
They cited a 50% reduction in payment processing fees by using the Lightning Network compared to traditional rails.
Wow. Half the cost. I mean, who would thought a burger chain would be pushing layer 2 adoption? That's real business utility right there.
Exactly. It's not just speculation anymore.
Yeah.
Okay, section 4. Technological evolution and the regulatory chessboard. The focus is really shifting towards utility now, especially on Bitcoin scaling solutions, the layer 2s. We saw some pretty big moves in the layer 2 wars this week.
Yeah, tell us about those upgrades. Stacks had something big.
Stacks activated their Nakamoto upgrade. Two key things there. First, fast blocks, which brings their block confirmation times down to around 29 seconds. Much faster.
Okay, faster is good. What else?
The second part is maybe even more important, 100% Bitcoin finality. This means Stacks transactions effectively become as irreversible as transactions on the main Bitcoin blockchain itself. That's a huge boost for security and reliability, especially for smart contracts built on stacks.
Makes it feel more like part of Bitcoin itself. And Rootstock, their competitor, they had news too, making things cheaper.
That's right. Rootstock activated an upgrade for their bridge. It enables SegWit support, and the expectation is that this will cut the fees for withdrawing Bitcoin back to the mainnet, what they call peg-outs, by up to 60%.
60% lower fees, that's significant.
Absolutely. Both of these major Layer 2s are moving beyond just theoretical potential. They're delivering practical improvements, faster, more secure, cheaper utility.
Now, shifting from Layer 2s to mining, there was a really fascinating story about Core Scientific and CoreWeave. The acquisition fell through.
Yes. The proposed $9 billion acquisition of the Bitcoin miner Core, the scientific by AI cloud provider CoreWeave, was terminated. And the reason why is the really interesting part.
What happened?
Proxy advisory firms, the ones who advise shareholders on how to vote, basically argued that the deal undervalued Core Scientific's physical infrastructure assets.
Their data centers and power agreements.
Exactly. They argued those assets were worth more in the context of the booming AI sector than they were as just part of a Bitcoin mining operation.
Wow. So the market is saying the picks and shovels, the infrastructure, might be more valuable than the gold they were mining, in a sense.
That's the implication. It's a massive signal. The market is starting to view these miners not just as leveraged plays on the Bitcoin price, but as valuable energy and infrastructure companies that can pivot to service the huge demand for AI compute. It's a potential decoupling of miner value from crypto price volatility.
That is a profound shift in how these companies might be valued going forward.
Okay, what about the regulatory side? Still seeing that global contrast? Very much so. In Europe and the UK, we're generally seeing progress towards stability and integration. The UK's FCA finalized rules for retail access to crypto ETNs exchange-traded notes, with strict safeguards, but it opens the door.
Providing a regulated path for everyday investors.
Right. And in the EU, the MiCA regulation continues its implementation, providing that long-term legal certainty across the bloc. The ECB also advanced the digital euro timeline, aiming for technical readiness by 2029. Things are moving forward there.
But meanwhile, back in the U.S., still stuck.
Still pretty much gridlock, yeah. Bipartisan talks on that comprehensive market structure bill, the Clarity Act, have apparently resumed in the Senate. But sources are saying passage before year-end would basically require a miracle. Still seems unlikely in the short term.
Frustrating. But interestingly, while the U.S. legislature is stalled, we saw some movement at the sovereign level elsewhere.
Yes, quite notably. Lawmakers in both Germany and France proposed motions advocating for Bitcoin to be considered for inclusion as a national strategic reserve asset.
Putting Bitcoin in the same category as gold reserves, potentially.
That's the conversation they're starting at a national level. It's a significant symbolic step, even if it's just a proposal for now.
Yeah.
Okay, so let's try to synthesize this whirlwind of a week. On the one hand, you absolutely saw a major risk reduction event. The Fed's cautious stance drove institutional selling, particularly through ETFs, leading to that sharp negative price shock.
The fast money reacted.
Exactly. But underneath that surface turbulence, the foundational long-term thesis seems to be strengthening. The tokenization of finance, actual Layer 2 utility coming online, the infrastructure build-out for things like RWAs, and even AI using miner assets. That's all demonstrably accelerating. The slow money is still building.
So for listeners trying to gauge if the short-term pain is easing, what are the key things they should be watching right now?
I'd say watch two main things closely. First, look for a reversal in those daily spot ETF flows. Consistent net inflows would be a strong signal that the wave of institutional selling might be over.
Okay, ETF flows turning positive again. What's the second?
Second is the price itself. Watch the market's ability to defend that critical support level we talked about, around $109,000. If that floor holds despite the macro headwinds, it suggests this dip might just be transitory, a shakeout, rather than the start of a deeper downturn.
Got it. ETF flows and the 109K level. So wrapping this all up, what's the bigger picture here? What does it all mean?
Well,
we saw Wall Street, or at least parts of it, effectively say this week that Bitcoin mining companies might actually be more valuable as infrastructure providers for AI and high-performance computing than they are as just pure crypto plays.
that decoupling signal was really strong.
It raises a pretty important question, doesn't it? Something for you, the listener, to really mull over this week. If the value of the infrastructure around Bitcoin, the energy, the data centers, the financial rails is starting to decouple from the day-to-day volatility of Bitcoin, the asset itself, Does that mean the next phase of growth for this whole ecosystem might be driven less by pure price speculation and more by the fundamental real-world demand for digital compute, for secure energy, and for those efficient digital financial rails? Where does the value truly lie going forward? Something to think about.